Good morning and welcome to Author's Note. I'm James Mackintosh, standing in for John Authors. Today markets are down, rather bad start except in Italy, where equities have made some fairly decent gains, hopes rising once again for some sort of Eurozone solution. Today though, we're going to talk about one of the things everyone's been worrying about, which is where do you get safe assets? And really, are there enough of them around? With me, I've got Geoffrey Yu, currency strategist at UBS. Jeff, welcome.
Thank you.
If we bring up the first chart here, I think this very nicely shows how the pool of high quality bonds out there has been shrinking. We've got the situation before the downgrades, then those left with 3 AAA ratings, then a further drop, those with 3 AAA ratings and a stable outlook, and then as time's gone on, the UK's fallen out and even Germany's fallen out, and really there isn't that much out there for people to buy. What does this say about what should happen to prices?
Well, right now what we're seeing in the FX market in particular is just, despite our concerns about valuations and currencies and about market positioning, currencies like Norwegian krone, Swedish krone, Australian dollar, they're just still flying. You really can't justify these levels based on where global growth is. If you look at Sweden's exposure to the Eurozone growth, for example, but that's just the way it is right now. People don't worry about paying a premium as long as they know that they're protected fiscally and also from a monetary point of view. Why people hold Australia, it's a commodity block currency, so they think they're protected from QE.
So this is safety at any price people are willing to pay to get into that tiny sliver of remaining totally secure asset.
Indeed. If you look at Switzerland, for example, I mean, even though right now it depends on your view on how the SNB can hold its floor, but assume that there's no FX risk right now, you're definitely not gaining any FX benefits. The Swiss franc is not going to be allowed to appreciate. And Swiss T-bills right now, they're at negative yields, but clients are very happy to hold that. Our internal flow data, looking at wealth management flows, for example, 17 straight weeks basically since the Greeks had their first election. It's just been relentless buying without,
people are just piling into Switzerland no matter what.
Absolutely. And if you look at its wealth management flow, that means that private investors, that sticky money, they're actually selling their assets in the Eurozone, putting them in Switzerland, and they're going to keep it there. It's not like hedge funds or even asset managers who can more actively diversify the portfolios. It's just protection. Well,
if we move over to the second chart, I think we can see some of the demand side issues here. In red, we've got the growth, the quarterly extra money, this is in billions of dollars, being put into foreign exchange reserves, which is, of course, one of the very big drivers of safe assets. And then in blue, we've got flows into mutual bond funds. It does suggest that actually a lot of the move here is being driven by governments buying other governments' debt. Is that the big driver, or is it more, as you're talking about, the private sector that's a sort of marginal buyer here? I
think it's a bit of both, really. There's been a lot of focus in the second quarter on what Switzerland has been doing, for example, with its massive growth in reserves. Switzerland's very open about which currencies that they actually buy in, and most of them are AAA. But if you compare the total stock and potential flow of new assets, private sector investors, they still outnumber global reserve managers by far. And these investors, they're finding a very crowded situation, and with central banks cutting to zero, short rates heading to below zero, maybe they just need to change their business model. If they need yield, then they just have to go down the rating scale.
So you mean that AA is the new AAA?
Probably, yeah. So I remember when the discussion we had internally after the ECB cut its depo rate to zero was not what do people do with their money, but should money market mutual funds, for example, who only invest in AAA assets, should they reconsider their business model? Otherwise, they're going to just go out of business. Right?
Yeah, well, that's a scary thought. Well, Jeff, thank you very much.
Thank you.